I'm joined by Aaron Dunn, Senior Equity Analyst at Keystone Financial. Aaron, I'd like to ask you, what is your methodology at Keystone Financial of combing through thousands of stocks in Canada, or companies in Canada?
Okay, so we have a very specific criteria, and what we do is we start at the bottom of that criteria and we go to the top. The first thing that we're looking for is a company to be investable to us. It has to be profitable.
Okay.
If it's not a business that's generating positive free cash flow from current operations, then it's going to be far too speculative for us.
Okay.
So we need to see that profitability. After that, we want to see that the company is growing. Are the revenues growing? Are the profits growing? Are the margins stable? Or are they improving? Beyond that, we want to make sure that the company has acceptable financial risk. So that comes down to the balance sheet, the debt, the assets. We prefer a company that has a low level of debt. Some companies will have more debt, and that's acceptable, but we want to make sure that a company is not over leveraged. And then we want to talk to management, we want to understand the story, and we want to understand the future and what the outlook is. So we want to make sure that even though a company has delivered strong growth historically, doesn't necessarily mean that that growth is going to persist into the future. So really the art of the investment research is understanding the market that they're selling their product or service into, and ensuring that that growth is going to be sustained.
Right, and as an analyst, why do you like small cap stocks that pay out dividends?
Okay, so I like small caps and I like companies that pay out dividends. So when you put the two together, that's the secret. That's the best situation for us. What we like about small caps is that there are a lot of companies out there, small companies, they're very profitable, but they're not well known. So if you have a larger company that's profitable and growing, it's most likely well known. It has a lot of analysts covering the story. So the share price, the value relative to the underlying earnings is going to be more expensive. But there's a lot of opportunities when you look at smaller companies that are less known, that are just kind of coming up. They've broken through into profitability and now they're growing, but they don't have much of a following. So if you're able to purchase a company like that before the larger market really understands the story, then you benefit from the earnings growth in the company, but also the valuation expansion once more people start to learn about the story. Institutions, larger investors get in, they push the share price up, and that's great for investors that already own the company. And then of course, when you look at dividends, if you look at historically the statistics on dividends, specifically companies that pay and grow their dividends, through both a long-term and a short-term time horizon, they vastly outperform either just regular dividend companies or non-dividend paying companies. There's a lot of value in getting that capital return to shareholders.
Right, and do you have any picks in Canada or in the US that have long-term dividend paying out companies?
Yeah, absolutely. So one that we recommended 2 years ago, it's a Canadian company called Exchange Income Corp.
Okay.
So basically what this business does is they look for other businesses to acquire, simple profitable businesses that they can roll into their framework and they can grow profitably. They're mostly in the specialty aviation market, but they have a lot of different services they provide, from airborne surveillance for intelligence agencies to firefighting to training, all sorts of different things. But when we recommended them 2 years ago, what we really liked is they had just announced a very large acquisition. There was a very visible growth profile in front of them. They were inexpensive relative to their underlying earnings, and they paid a really nice dividend yield that was growing. So we recommended them on that basis. We liked the fundamentals of the company. They integrated that acquisition, and since then, the free cash flow per share has doubled, and so has the share price. And they've increased the dividend as well. So you're getting huge capital appreciation, but you also started off with a 7% yield on top of that income yield that has grown since then.
Very good. Thank you so much for your time. Do you have anything else that you'd like to mention about Keystone Financial for our audience?
Absolutely. I think that one of the most important aspects of Keystone, of our strategy, is that we're completely independent. So we don't accept money from the companies that we recommend for research. We don't do any type of financing arrangements with them. So the strategy of Keystone, and I think it's one of the things that really does make us so successful, is that we have no bias. We are only successful if we can provide good recommendations to our investor clients, and if they do well from those recommendations. And that is a really important thing to understand if you're using any type of a financial advisor.
Very good. Thank you so much, Sharon.
Thank you.
To learn more about Keystone Financial, be sure to check out keystocks.com. I'm Rachel Lee for SmallCapPower.